Rigel Neal Interstate Banking and Branching Efficiency Act of 1994 permits adequately capitalized and managed bank holding companies to acquire banks in any state 1 year after enactment. Concentration limits apply and CRA evaluations by the Federal Reserve are required before acquisitions are approved. Beginning June 1st, 1997, allowed interstate mergers between adequately capitalized and managed banks subject to concentration limits, state laws, and CRA evaluations. Extends the statute of limitations to permit the FDIC and RTC to revive lawsuits that have expired under state statutes of limitations. Next, Economic Growth and Regulatory Paperwork Reduction Act of 1996 requires the Federal Financial Institutions Examination Council and its member agencies to review their regulations at least once every 10 years to identify any outdated or unnecessary regulatory requirements imposed on insured depository institutions. Amended the Fair Credit Reporting Act to strengthen consumer protections relating to credit reporting agency practices. Established consumer protections for potential clients of consumer repair services. Clarified lender liability and federal agency liability issues under the Comprehensive Environmental Response, Compensation, and Liability Act. Directed FDIC to impose a special assessment on depository institutions to recapitalize and Savings Association Insurance Fund, SAFE, and align SAFE assessments rates. Next, Graham-Leach-Bliley Act of 1999 repeals last vestiges of the Glass-Steagall Act of 1933, modifies portions of the Bank Holding Company Act to allow affiliations between banks and insurance underwriters, while persevering authority of states to regulate insurance. The Act prohibits state actions that have the effect of preventing bank-affiliated firms from selling insurance on equal basis with other insurance agents. Law creates a new financial holding company under Section 4 of the BHCA, authorized to engage in underwriting and selling insurance and securities, conducting both commercial and merchant banking, investing in and developing real estate and other complementary activities. There are limits on the kinds of non-financial activities these new entities may engage in. Allows national banks to underwrite municipal bonds. Restricts the disclosure of non-public customer information by financial institutions. All financial institutions must provide customers the opportunity to opt out of the sharing of the customer's non-public information with unaffiliated third parties. The Act imposes criminal penalties on anyone who obtains the customer information from a financial institution under false pretenses. Amends the Community Reinvestment Act to prohibit financial holding companies from being formed before their insured depository institutions receive and maintain a satisfactory CRA rating. Also requires public disclosure of bank community CR-related agreements. Grants some regulatory relief to small institutions in the shape of reducing the frequency of their CRA examinations if they have received outstanding or satisfactory ratings. Prohibits affiliations and acquisitions between commercial firms and unitary thrift institutions. makes significant changes in the operations of the Federal Home Loan Bank system, using membership requirements and loosening restrictions on the use of FHLB funds.